had the same opportunity, by the way, to get rid of unsound banking during 1933, the Great Depression. The banks were going under. They were collapsing as we spoke. And but we had two alternatives then. One is the alternative allowed them to go bust, and that's it. We go back to the hard gold currency. Forget about paper money and fractional reserve banking. The other route was taken, of course, by Roosevelt, and would have been taken by Hoover, which is, of course, to save the banks, go on to a paper finance standard, and all the rest of it, have guaranteed deposits and all the rest of it. Now, some of my close friends are in favor of eliminating the FDIC, government insurance, and substituting private insurance, okay? Privately financed deposit insurance. Well, I'm not against it. I mean, if you want to, it's like an entrepreneurial point. If you want to set up a private deposit insurance corporation, you're free to do it. Just you undoubtedly go bust. Remember what happened to the Ohio and Maryland private deposit insurance firms a few years ago. One bank was a crooked bank, and that went under. Immediately, all the other banks, people got scared, and the bank run occurred. The bank run, by the way, is a beautiful and magnificent institution, so spread like that. And once it spread, nothing can be done about it. And I think that's an instructive lesson, because the banking system is the only industry in the United States I know of which rests only on public confidence. You know, they always talk about, hey, we can't tell the public that S&Ls are collapsing because it would ruin the confidence of the public. You don't see that applied any place else. Nobody talks about the importance of confidence in the computer industry or confidence in the TV industry. They've got TVs to sell, right? They've got computers, which are good, and they work. Confidence rests on the soundness of the product, not on flim-flam and smoke and mirrors, which it does in the fractional reserve banking system. That's why confidence is all important, because they ain't got the money there, folks. They ain't got the money. Now, there's a dispute among my friends about whether the public thinks that their money is there in the banks. I mean, take a poll. I think they all think it's there. And even my students, after a semester of brainwashing, still really believe it's there. So they think the money is there. They don't think it's being loaned out somewhere and it ain't there. So anyway, that's, I think, again, an instructive lesson which should be learned. To me, the idea of insuring the fractional reserve banking system, or insuring the S&L, is very much like insuring the Titanic after it hit the iceberg. No percentage. You're free in the free market to do it, but there ain't much percentage in it.